truly successful in gaining the financing nowadays, Nimrod, you mentioned obviously you have to have the right team. And I know from my experience in Israel, the right team oftentimes is not necessarily the most savvy business person, but chutzpah like you wouldn't believe, basically. And more than anything else, they always seem to recognize, as I think somebody else in one of the earlier panels mentioned, Israel, a country of 7 million people, cannot afford to essentially focus its entire business model exclusively within Israel. So it's always about how quickly can I commercialize this, as opposed to perhaps what we see more often here in Canada, which is an innovative idea, but the management of that company oftentimes can't seem to think beyond the tinkering and gets overly caught up on tinkering and not necessarily on how to commercialize it as quickly as possible, which obviously then has a more direct impact on your appetite as VCs to fund that. Can you sort of build off of sort of a bit more dialogue in terms of what you prefer to see, how these founders of these innovative companies, these startups, should actually be trying to think, whether it's the Israeli or using your experiences in Israel and Morry and John and Mark with your experiences here, but just to build off of that theme for a moment, if you could.
Yeah, basically, if you look at the market today, and you look at, and before me sat down here, Nissim Darvish, who said, our main goal is to bring ROI to our investors. And if you look today at the possibilities of a positive ROI, and that is what most of the angels in Israel are aiming to, is to try to take the company to build a budget that will, in minimum time and minimum budget, will reach a product. But that is not good enough, and that is what Morry said before. You can't just work as you did before, find the technology, build a product, and then go to the market, hey, who wants to buy that? It doesn't work anymore. And you said again, the technology and the buildup of the product is one thing. But if you operate in the European market, that's one thing that's one focus that you should build the company toward that market. And if you go to the Eastern market, you build it a whole different way. So I think the main issue here is when you look at the technology in its initial stages to find out where are you going to take it. Are you going to take it to the North American market? Are you going to take it to Microsoft? You got to build it in .NET. Are you going to take it to Google? You got to build it in Python. You got to use, at the initial phases, you got to locate the right market, the right buyer, the right infrastructure you want to hook up this technology to, and then you can gain fast ROI, contracts, break even, and the company stays alive. Now, most of the angels that I'm working with do not believe anymore in revenues and in dividends. It just doesn't happen. They look for the possibility for an exit, which can be IPO or M&A. And that is something that will give them positive returns. But then again, in Israel, there was a lot of people saying, you can't sell companies for $20, $30, $40 million. You lose the technology. And I think the best example I can say, as an example we heard before, is a company that we put in $550,000 about 4 years ago, and 2.5 years later we sold the company for $25 million for Autodesk, and now this is the innovation center of Autodesk in Israel. So it can be done if you build it in the right way. Now, angels today, investors, should be either masochists or crazy to invest in technology, because if you look at statistics, the returns are almost zero. So we believe, and that is what we're trying to build, we believe that you have to build a different model to invest in startups in order to bring ROI. You have to make the due diligence when you bring the buyer or you bring the market to the table at the first stages. And one of the things I was trying to tell people here, that if you want companies to come here, and you look at the New York Stock Exchange, which is 30 minutes from here by flight, and you see Israel is number 2 listed, and you look at the Toronto Stock Exchange, which is way more appealing to companies, and you see almost 0 companies here. It's not because they can't do that. It's because they don't build the operational here.
I was going to clarify, from Israel.
From Israel, sorry. From Israel. I'm talking only about companies from Israel.
But there's a difference, right? If you compare Canada to the U.S. in that scenario, we're accused of ROI versus absolute return or growing companies to the big level. The chase for the locked-in exit gets us out of companies in the $25 to $100 million range, and we don't have enough companies being built out to multi-hundreds of billions. So if you're right, if you're the angel looking for the absolute ROI, building and investing in companies that have low capital need, that can get you an exit in 2 to 3 year window makes sense. If you're trying to build bigger, broader, global companies, depending on the industry, MaRS companies, they're not going to need as much capital because they're in social networking. They're not in like the semiconductor business. So the capital pool requirement is going to be different. So depending on the investment thesis you choose, you're going to have a different need and your horizon. But if you want to build big companies, you need a pool of capital that's going to allow, if it's a $15, $20 million, so from series from initial investment to exit, you got to have the runway to get there, and the company has to have patience, the investors have to have patience to see it through to the end, so you can actually realize on the value. We've been caught up in the let's get out early so that we can show the return, but that's then leaving things behind that maybe you could grow to bigger.
I absolutely agree. That is why we're focusing only on software. It can't be done in other areas. And as private investors in Israel, we're trying to focus on software. We can't, in this model, we can't invest in life science. We can't invest in hardware. It won't work. It just won't work. And I absolutely agree that you will need the capital for those areas.
But having said all that, I mean, I think an exit at 25 or 100 million, John, depending on how much money you put in the IRR, can be a very good thing, right? And I'm saying I don't think that in and of itself is a bad thing, as long as we keep having successes and people work there and they see how it's done, and they have role models to follow and they have examples, and more jobs are created and there's more innovation. So I think the exits are a good thing. John's talking about a world-class company, but I think $25, $100 million exit where the investors make money, they hit their returns, and the whole ecosystem is seated again. That's also a positive thing.
But so back to IRR versus return. If you put $5 million into a company and you get out $10 or $15 million as a total exit, that's a good IRR. But in terms of now, when we're trying to go leverage institutional capital and get institutions to invest, you got to give them a significant return to make their money be efficient compared to their alternate sources of use. So you need both.
Mm-hmm. I have just some statistics because I think healthcare, and particularly medical devices and pharma, are a little bit different than what you're talking about.
Absolutely.
Number one, there's a much longer stretch of time. Number two, in 2009, the average medical device, there were 10 or so, I can't remember exactly the number of acquisitions that took place, but the average was for healthcare was $200 million. So the average exit was $200 million. And if you work backwards from that, you sort of say, well, $80 million is sort of, you can't put more than $80 million into the company to get a reasonable return. So number one, you have to really choose companies correctly. You can't, again, you can't just, it's not the build it and they will come kind of thing. You've got to be different than that. So you have to choose correctly. You have to make sure that even in a thing like a medical device company or a pharma, the stretch, the investment doesn't go above 80 million. Otherwise, you can't provide the kind of return that you have. It's interesting from another statistic that we've found that's very interesting is that in funds, and I'd like to hear what people say about this, in funds that are between $100 million and $200 million, they actually have the best return. Those funds that are $200 to $1 billion have a much worse return than those that are under 100 to 200. Actually, 100 to 200 is the most. The next number is 0 to 10. So anybody who gets, a very small fund, usually it's because they're very involved in the companies, and that's another thing that I think the VC has to be very involved in the company. They have to be prepared to change management. even though it's a tough thing to do, they have to help in making sure they understand how to do the marketing, because they probably won't help a lot in the technology, but to help a lot in the marketing, to help a lot in the go-to-market strategy, to help a lot in the how to create the correct distribution channels and some of those other things. It's the same in general. It's a bit, in healthcare and in medical devices and pharma especially, it's a much longer horizon, and it's a lot more money. So you have to be very careful in those things.
Just one little point to this. A question that I ask, which there really isn't a right answer, but it does help understand the person you're dealing with. When I see a new company, I ask the entrepreneur, what's his happy plan number? What's the number that he'd like to realize on that he would sell this company for? And it helps you gain a couple, 2 or 3 different perspectives. That gentleman's risk appetite, or that person's risk appetite. If it's a company that, let's say I estimate it's got a maximum of $50 million exit, and he says he wants to make 50, he's also unrealistic. So it depends on the situation and what it is. But one of the things in Canada, though, that unfortunately, when you compare it to the U.S., that person's happy with making $5 million, and there's nothing wrong with making $5 million, but maybe his U.S. counterpart would want to make 50. And so in terms of how and where you take things to and the return profiles.
Just let me react to one quick thing that you reminded me about. I get a lot of business plans, and I'm not an MBA. I mean, I never got any training.
It's always
as an
$50
MBA
million in the third year.
I mean, right?
Always $50 million.
Exactly. So what I see in those business plans is that in 5 years or 3 years, they tell me they're going to make $52,873,462.87. So they have something to 8-figure accuracy, when I know that there's no way they're going to know what they're going to do next week. Forget about it. So what do I ask? I said, maybe I've had the advantage of not having an MBA training. So what do I ask? I say, just tell me a couple of things. Number one, how many of these devices do you have to sell, or whatever it is, in order to break even? And then how does that compare to what the market is? And those 2 questions, I'm amazed, are very rarely able to be answered. I don't care about all the other numbers. Those are the 2 or 3 numbers that I really, really want to know. It's like what you're saying. Now I'm going to ask that question that you said, because I think that's a really good question. What do you want to sell this company for in the end?
Morry, I want to actually build off of that in part because I'm getting the cane from center or stage left to wrap it up quickly here. What could a smart company, smart management of a company do to make sure to best maximize their chances of getting capital from you when they come in to tell their story? What should they do quickly, and maybe 1 or 2 things that they probably shouldn't do, such as the hockey stick projections that nobody believes anyway?
Well, since I'm acting in the early stage sector, and I'm looking at entrepreneurs which are mostly technological, the things that we look, except for the technological innovation, is one, if the entrepreneur knows his step. And Morry said before that they're changing management. We don't change management. We take over the management in day one, and we bring the management with us. That is why we have 12 people on board, and we're investing in 12 companies only, because that is the only way you bring value. But that is one point. Second point, time to break even. With the minimum resources, you got to take the sword off the neck. And third thing, you got to build focus to a certain place, to a certain sector, in order to bring the company to the right point at the right time. And you got to bring that people on board from day one to help you maneuver the company to that stage. So,
John, your 2-minute pitch in 20 seconds.
No, we've got Rafi hooking, so
Wrap it up.
the hook is there.
I've been told, unfortunately, we couldn't take any questions at the moment, but I think all of our panelists will be around afterwards. Thank you, all of our panelists, both, especially from our Israeli contingent, but Mark and John as well. And thank you for sticking around. I'll hand it back to Dr. Hofstein.